To introduce ourselves, I'm Alex Wilson, broker owner of REMAX Wealth Builders Real Estate, also a real estate investor. My portfolio is 14 condos, a triplex in High Park, and an apartment building in Hamilton. Kyle DeVigi is our director of operations, also an investment specialist. He is also a real estate investor. And then our guest of honor, Sanjeev, founder, partner at S&A Partners, CGA accountant-wise, been doing this for over 35 years. And more importantly, an avid real estate investor. And I do work with him. Our company does work with him. He is not your regular accountant wise. And what I mean by that, his ability to communicate complex structures in a language that people can understand, and he's willing to work with you, I think is absolutely incredible. I don't feel like he's telling me I need to do something and I don't understand what he's telling me. I feel that we work together to create a solution. It's really a breath of fresh air. So that's why we like having Sanjeev on, and really everyone that's on here, you may be a small investor with 1 or 2 units. You could have 10 plus units. The concepts that we discussed today will allow you to get to 10 plus units. Or if you have 10 plus units, you'll probably learn to have a better, how to put a better structure in place, kind of what Sanjeev and I were chit-chatting and Kyle and I were chit-chatting about before we started this all. So we're all about minimizing your stress and maximizing your wealth. And if we can minimize tax stress, you're definitely going to maximize your wealth. So Sanjeev, why don't you just give a quick little bio on yourself so everyone knows who you are, kind of and expand beyond what I just said.
Hi, good morning, everybody. Welcome. And just a brief about me is I have been an accountant for the last 35 years, started in the year 1985. And it's I would say 35 years and 1 week today. That's the way I would put it now. Yes, I am a real estate investor, but as Alex said, the best, I would say, advantage of taking my advice would be if you're above a threshold. Mm-hmm. If you are below a threshold, I might not be able to help you, because last week when I got some feedback from the clients, someone holding one real estate or 2 and do not want to grow. In that case, I would say they're better where they are. So anyway, yeah. So I've been doing accounting for the last 35 years. We are based out of Oakville. We have a decent staff of more than 17 people, plus my own family, which is another 4 people, but 21 in all. So we try to take cater to the needs of small and medium, I would say small and medium investors. Because since we are investors.
I want to add that you are truly a family company, and that's important, because everything we're talking about in real estate wise, it's all long term. So the day that Sanjeev decides that he wants to slow down his workload wise, son is still in the business wise and there to take things on. So Sanjeev's not going to disappear, or a Jane, I guess, will always be there to handle your needs through the lifetime of your portfolio. That's the way to put it.
Sorry, guys. So I'll be glad to answer any of your questions, if any. But if you have any questions which have not been answered here, the best thing is just send an email. I'll respond back.
Yeah.
And I have been asked this question from quite a number of people, but let me tell you guys, when I respond to any person for the very first time, there is no cost to it. So don't be fearful. Just send an email. You will have an answer. It might be late, but you will definitely get an answer.
And again, to let everyone know, this is Sanjeev's busiest time of the year. So patience is the key thing. And again, he's giving us his time for free. So because we did our first webinar last week, we learned things. We learned how to structure things. And definitely where we saw the most number of questions were actually how to grow And so we're going to get into that in a second, Wise, but I want to, for the more junior level investors, Wise, I quickly wanted to go over the common write-offs for an investment condo. And I made notes on these already, so I can quickly go over those. And I'm going to send a summary email to everyone this week so that everyone knows, here's the things that you can write off on your condo currently, Wise, that you may not even be doing right now. So obviously you have your standard ones, your maintenance fees, your property taxes, any repairs and maintenance. Very important. Interest on your mortgage. Some people don't realize that interest on your mortgage, that is a tax deductible expense. One thing that we all learned last week was mileage. When you drive to the property, by keeping a logbook, you can write off the mileage against the income that's coming in on the property, Wise, which is the prescribed rate of 52 to 54 cents, which when you look at it compared to if you were calculating the gas expense and the repair and maintenance of the vehicle, Wise, if you just do the mileage, you're going to have a larger write-off against the property, Wise. So if you keep a logbook, you're able to write that off. And then the general rule of thumb, if you can relate any expense to the actual property, you can write that off against the income coming in on that investment property. Obviously, you can't write off a trip to Mexico on the property, Wise, but within reason, any expense that can be related to the property, you can write that off. That is what you can do. So you always want to look at that. Now, where you get to growing your portfolio, Wise, if you have excess cash flow. And this is where it gets really exciting, Wise, is when you have excess cash flow, and we talked about it last week. Sanjeev, if you're in what we were talking about, the tax bracket, the 43 to 54% tax bracket, if you have excess cash flow, you need to look at finding ways to increase your portfolio size using the equity in the property by increasing your interest expense. So what that means is, remember, the interest on your property is tax deductible. So we want to actually increase the mortgage amount on the property, take money out on the property. So let's say we take $100,000 out on that property, your interest expense will go up. But if you have excess cash flow, that's okay, because the excess cash flow is going to pay for that. And because you're at this higher tax bracket of 53, 40, 48, 54%, that's all getting taxed away anyways. You're better than taking of that 100,000, putting into another real estate asset. Now you have two real estate assets that are continuing to go up in value, and then you just repeat the whole process, and you get into a large portfolio of 10 plus properties. And that's when you get into the different structures. If you're setting up holding companies or various things along that nature, Wise. So one other question that I have, and we talked about it last week, and I think it's a good question to have re-answered, is should you be depreciating the investment property?
The answer to that is yes, you can depreciate the investment property. There's no problem to that. But what is going to happen is, when you depreciate, you will save on taxes in the year you depreciate. But eventually, when you sell it, the whole depreciation amount of depreciation which is claimed will be clawed back.
Yeah.
And that'll be taxed at the then tax rate. And the income for that year when you make a sale is obviously going to be higher.
Mm-hmm.
So yes, if it is going to be a very long term,
mm-hmm.
I would say do it. But if it's a short term, please don't do it.
Yeah. Yeah. So again, and everything we talk about today is specific case by case. Everyone is going to have, once the books are opened up, are going to be in different situations, Wise. But I'm under Sanjeev's boat. I don't love it as a write-off, Wise, because generally as it is, the tax on your coming in on the income coming in is lower. But when I disperse of the asset, I'm going to have a big jump in my income that year because of the appreciation of the property. And I'm going to have to pay additional tax on that during that time. Now, I love this answer because I get to ask this question a lot, and now I actually have an answer. It was always kind of a gray answer for me. You, no, actually the question is, when I use my home equity line of credit on a pre-construction condo, can I write off the interest on that home equity line of credit?
Yes, sir.
Yeah. There we go, people.
That's a very simple answer. Yes.
Yeah.
The whole
Yes.
purpose of making an investment was to make money in future. If the objective was to make money in future, so it is a kind of a business, passive or active. So any expense related is a write-off.
Yeah. So there you go, guys. You can write off that interest. I think that's a very, very important question. And that's something where if someone is using your principal residence to start up their journey wise using a home equity line of credit. So if you've been paying off your mortgage of your house that you live in every year, you're doing the right thing. Unfortunately, the rate of return is absolutely horrible if all that equity is tied up in the property. So what it is you pay down the property, but then if you use your home equity line of credit, you can then redisperse that into an investment asset. And then you can write off that interest expense. But when you're living in the property, that's debt, and you can't write off that interest that you pay down on your mortgage wise. But if you reinvest the home equity line of credit interest into an investment asset, you're going to make money, and you can write that interest off. So that's something that's important to know. Also, if anyone has any questions, you're going to use the Q&A button at the bottom of your screen, and we will be answering questions. Now, what is a holding company, Sanjeev?
Holding company is, of course, a corporation, like any other corporation. But the objective of that corporation is very limited to an extent that the corporation will not be involved in any other business activity. That is what the banks wants to know. And we restrict the objective of the corporation, the activity of the corporation, to holding assets and investments only.
Yeah, I can't stress this enough because I'm sure Sanjeev's seen it, I've seen it. You do not buy your investment assets in your operating company. So what an operating company is, that is the company that you make your day-to-day money in. That's your business. So my business is selling real estate. I have an operating company that does that. Sanjeev's business is doing accounting. He is an operating company that does that, and that's where his income comes in. His holding company is the company that is going to own his investment assets. And you're going to have, if you have, let's say, stock market assets or equity assets versus real estate assets, those are going to, you want those in two separate holding companies as well. You want to keep those separate wise. So what we're specifically saying, if you're buying a real estate property, you want it specifically only in the holding company. Other things that came up, people asked, what is there a limit to the amount of holding companies? No, you can have as many holding companies as you want. There's ongoing costs on maintaining the holding companies, but you can have as many holding companies. Now, Sanjeev, how many real estate assets or the value of the real estate asset do you recommend holding in one holding company?
You know, there is no defined definition for this, I would say. Mm-hmm. But generally, what I do not like to have more than 4 in one. Mm-hmm, mm-hmm. It's a rule of thumb, max 4. Mm-hmm.
Yeah,
and after 4, please get one more.
Yeah, and that's there's liability and everything involved in that as well, and how you structure that with your accountant and with your lawyer wise. So there's a balancing out of what the bank's like. And again, going back into the operating holding company, if you bought a real estate asset in your operating company, the bank won't give you a mortgage on it, which it will not happen wise. And part of that is they like to mitigate risk. So if you had that property in your operating company and you got sued for activity in your operating company, that means that they could take your real estate asset or make a claim against your real estate asset, and the bank doesn't want that. So the bank will not give you a mortgage if your property is in your operating company wise. Now, if you bought something pre-construction wise, and let's say you just put your operating company on it, you have time to change the company, the company on it. If you bought it under your own personal name and you want to close it under a holding company, you can still do that and close it under the holding company. Those aren't any issues at all. But if you have an operating company, you do not want to put the asset in the operating company. Which we also talked about last week as well. If you are self-employed and you have excess income, 100% you should be buying your real estate assets in a holding company wise. What I mean by the excess income is that you have the set amount of money that you need to live on a day-to-day basis wise. Excess income is that, let's say you make an extra $100,000 within your company wise, and it's not something you need for your day-to-day activities. You can then, if you have the holding company, you can use that money from the operating company as your investment income in your holding company, because you can easily move the money back and forth from the operating and holding companies. And these are structures where it's very important to have your accountant involved to build these structures so that you can move the money between the two tax-free. There's no tax consequence between moving money from the holding company to the operating company. But if you move money from the operating company to you, Sanjeev, does that make your life a lot harder?
Oh, you are basically stripped of by at least one payment to the builder.
So it's just how you move money around and setting up the appropriate structures in that. Now let's talk a little bit more about how you move money from an operating company to a holding company. Sanjeev?
You know what, Alex? Every client is different, and the situation of every client is different.
Mm-hmm.
We need to remember one thing: when the money flows from one corporation to another corporation,
mm-hmm.
there is no tax on that.
Yeah.
But how to do it in a most tax effective manner, it is a
mm-hmm.
huge subjective issue again.
Of course, yes.
It depends how the person is really set up, because some people have multiple holdcos, mm-hmm. some people have only one holdco.
Mm-hmm.
So, long story short, the money moved from one corporation to other mm-hmm. as a loan is tax-free. If the money mm-hmm. moved from one corporation to the other by way of a dividend, even that is tax-free.
Yeah, yeah. And it is for everyone on there. You know, we may be talking about foreign concepts, or you've heard a friend talk about that. It's not hard to set up or understand when you sit down in front of Sanjeev or speak with him and walks you through every process. Every person is going to be different how it's going to be set up because of your personal structure wise, but the actual setting it up isn't that difficult to do. And these are all structures
in terms of numbers here.
Yeah.
I'll just explain in terms of, let us say a person is moving a $500,000 from his operating corporation to his holding company. The tax is zero. Mm-hmm. But if he transfers a $500,000 to himself, he will be dinged by a tax of at least, I would say, close to $175,000.
Mm-hmm. Mm-hmm. Yeah.
So that's a whole benefit in terms of cash flow, how we can conserve some cash to mm-hmm. make some additional investments. The tax anyway is going to be there. If not today, on a D-Day, which is the date of death.
Yes. Yeah.
But the longer you defer, you make money off that money, and then you can pay your taxes.
Yeah.
Taxes have to go anyway.
And that's, everything that we're teaching here and discussing today, it's all about structuring in the right way. And that's where we use the word minimize tax. You're always going to pay the tax. The tax man cometh. And that's a beautiful, paying tax is not a bad thing. You just want to pay it in the right way and at the right time. So if you structure it in the right way, and what I mean tax isn't a bad thing. If you're paying a lot of tax, that means you're making a lot of money. So it's not a bad thing. It's just you want to structure it in the way to maximize the return on your dollars that you brought in. And especially if you're self-employed wise, I'm not part of a major corporation with a pension plan. Sanjeev, do you have a pension plan? Sorry, well, I don't, you don't have to get into
I personally hate RSP or pension plans.
Yes, yes.
Not a penny.
Yeah, he doesn't have, we don't work for, actually I'll put it, it's not that we're a federal employee and we can rely on a pension when we get older. And here's the key thing too, to speaking of pensions wise, if you work for a major corporation and you have a pension wise, and we have videos on this when we've said this before, you cannot guarantee that pension will exist in the future wise. Great examples. We talk about Sears, we talk about Nortel. These were major corporations in the 80s and 90s, well, and even before that. But in the 2000s, they're gone. And when these companies go bankrupt and go under, there are consequences to the pension funds that they were funding. You don't get all your money. That money isn't guaranteed sitting there anymore. So just because you have a pension and you think you're relying on it, it doesn't mean it'll be there in the future wise. There's no guarantee. So what we ultimately do, what I call our pension plan is real estate. Real estate is our pension plan wise, and you invest in these real estate assets. And that's why you want to put these systems in place, because one or two is fine, but that's not really a true, you can't retire in 1 to 2 properties. You need that larger portfolio of properties that will be able to generate the cash flow in the future when you do want to retire, that you can live off those properties. And how you do that is if you have that equity in the property, and you have 1 or 2 properties, how you grow it to 10 properties is we take equity out of the first one or the second one. We use that equity to buy more properties. And now I have a spread of properties. I've used other people's money, the equity in my first properties, and grew it to 3, 4. Then I take the equity out of 3 and 4, and then I buy 5, 6, and continue on. And then I have this larger portfolio. And the beautiful thing, how this all works out, is time. Over time, there's people living in the properties that are paying down the equity in the properties, so that when you do want to retire, whether it's in 10 years, 20 years, 30 years, you will have all these paid off properties. 30 years, you definitely have all these paid off properties wise, because mortgages have 30-year amortizations. You're gonna have all these paid off properties. You'll have all the cash flow from the properties wise, and then you can live off of these properties. So that's how I actually build the true pension fund, and how to how to maximize the wealth in those is, again, building the structures, building the appropriate, if it applies to you, the holding companies around that, to build the tax efficient structure, so that you're maximizing the money that comes in today to build this portfolio. Kyle, Sanjeev, would you agree?
Alex, on this, I would like to add something.
Yeah, of course, yes.
That the times which we are in, people say these are the terrible times. According to me, this is the best time to build up a portfolio.
Oh, yeah.
And the other thing is that people generally ask a question, hey, how can we buy more? Because the bank will not give us a mortgage. This is here for the medium and a large investor, not for a small investor. If they can buy 5 units together, the mortgage will not be qualified based on their line 150. Their mortgage will be based strictly on the income approach. And that mortgage presently has a rate of interest between 1.59 and 1.79%. It's a 10-year rate. It's a 10-year rate. And the amortization is 25, 30, 35, 40 to a max of 50 years. You cannot go wrong. So you have to reach out to your realtor to buy 5 more. And of course, somebody who knows, who can get you a mortgage based on that, the plan I'm going to tell you. I'm not a broker. I'm not a
Mhm.
I'm not a mortgage broker, so I know because of my experience.
Mhm.
For example, one of my clients just yesterday he bought 9 units,
Mhm.
9 townhomes together.
Mhm.
We are getting a bond rate of about 1.79% for 10 years.
Mhm.
And we are stretching out the payment to 35 years so that he gets a cash flow for approximately, I think so, $10 or $11,000 a month.
Mhm.
So I would say buying real estate during these times is the best time to buy it.
Mhm.
It is always the best thing when the whole things are going south. That's the
Mhm.
time you buy it.
Yeah, you want to buy more,
But
and
then you need to have a very, very big heart.
yes, yes. Now, would this be a good? I think we should get into questions now. So we spent the first 30 minutes kind of having general topic wise. You know, we are doing the hard stop at noon. So let's jump into the Q&A right now.
Yeah, perfect. And everyone, please enter your questions into the Q&A panel. There's a little button at the bottom of your screen, and we'll try and answer all of those. There's going to be a lot of duplicates, so we may just dismiss those for ones that we've covered already. One very common topic, though, is why is a holding company beneficial? Why should you consider opening one?
The holding company is beneficial. It is beneficial for mostly for the people who have an income closer to 100, 150. That's a ballpark number. If you have very little, if you have income less than $100,000, I wouldn't say please go for a holding company. And specifically for the people who want to own only 1 or 2 properties or 3 properties, it is best to hold it in the personal name. This is from a tax perspective. But from a liability perspective, it is always better to have a holding company in play because it becomes a kind of a shelter between yourself and the asset in case of anything going wrong.
And should you limit the number of properties in each holding company?
I said there is no bar to that, but I generally keep it not more than 4.
And why is that?
Just from when I set up that thing, then any condo was between $600,000 to $750,000. I said, okay, limit myself between 2.5 million to 3 million, and keep it within the one corporation. As we cross 3 or 4, I go for the next one. When we do that, there has to be an umbrella holding company as well in that. And that umbrella holding company, when I say, will own all the holding companies. That really simplifies your tax structure. But then you will have to see your accounting for this.
That's definitely the advanced class in holding companies. And
I think the also to add on the why the holding company is important, and depending on if you're self-employed or not, the tax rate, the small business tax rate is much lower than your personal tax rate. So what's the actual small business rate, Sanjeev? Is it
right now we are 12.5?
12? So it's 12.5 on the small business tax rate. So if you are,
but the holding company will still have a higher tax rate.
yeah, you still have higher tax rate
because it's a passive corporation.
Yes, yeah.
But then there is that effective way to move the money out of the holding company to your personal side.
Mm-hmm.
To save on taxes. What happens is there is an escrow created when you pay the taxes. When I say escrow, that's a refundable tax. When you distribute that as a dividend, you get that money back. Generally, what happens, I've seen is out of the 2 spouses, one spouse has a higher income and one spouse has no income. So what you effectively do is you take the dividend out to your wife or your better half who has a lower income. So then the effective rate of tax will go down to 12%. Some people have larger portfolio. In that case, it might be advisable for them to open up the management companies.
Mm-hmm.
And the income on that management company is taxable at 12.5%.
Yeah. And that's where when you're building at the right times, when you're working with the right professional, you're going to be putting those, okay, now we've hit this threshold, we're going to do this. Now we've hit this threshold and we're going to do this. Everything comes with structure and planning wise, so you can grow that bigger portfolio. Very important. So I know, Sanjeev, you like to read the question. So if you open up the question and answer box.
I've opened up already.
Oh, you're in there. Okay.
The first one is,
Yeah, so read that. Read us the first question.
How can we sell rental properties without incurring huge capital appreciation taxes? Could I move or live in the condominium for a couple of years or need to pay taxes? I move into the condo. Any solution? Answer to a very simple question is, it is a very subjective question, answer. I don't know what's the actual situation on the personal side. So I can't really answer this. Yes, if you live in the condo for a few years, the tax will go down. But what if there is no room for appreciation? That's another question there. So I would say it's a subjective question. You have to take a call by talking to your accountant. The second one is, if I have a renter that defaults in rent payments, or I have months where I am not able to rent a property or lose rental income, is that tax deductible? Effectively, you're not including the rental income on your tax return. So the question of deduction doesn't even arise.
Yeah.
So if let's say you got only 12,000 for the year, you're only putting 12,000 on your tax return. So there is no deduction there. Yes, you'll be able to claim expenses for all the 12 months. There's no denial about that.
Yep.
And then another question is, do we have to open a business account if rental income is more than 30,000 per year, or continue to report? All rental income has to be reported on a T776. It's not business. It's a passive income. I'm renting a basement.
Do you open an HST account? Because it sounds like the threshold is an HST.
Residential income doesn't have any HST. Yes, if it is a commercial, you ought to have an HST number. But if the rent is more than $30,000, if it is less than 30,000, you can get away without HST.
On the commercial side.
Yeah, but it is always advisable to have the HST number, because when you pay for the expenses, there is an ITC component there. You can claim that the tax paid against the tax to be paid, to be claimed. So you effectively pay lower than you collected. I bought a property. No, sorry. I'm renting a basement of my primary residence. Should I pay back the mortgage faster and increase the equity to borrow against letter and invest the money elsewhere, and I keep the mortgage interest high to save on my taxes? A very, very subjective question. You have to look into your tax situation first. But ideally, I don't like to pay my mortgage faster. I like to keep the money to invest.
Well, I think in this case, so I know where he's going with this. In this case, I would actually, because it is the primary residence, which I assume that they own in their own personal name, most likely. So in this instance, I would pay down, and it's subjective wise, I would pay down the mortgage faster and then borrow against that to invest wise, and that becomes that interest is tax deductible. That's what I shouldn't say that. I do that personally.
Perfect. Yeah. Okay. Then it is, I bought a property and I will have a negative cash flow. Can I use the losses this year and use the remaining next year to maximize? The taxes are very clear. Any rental loss, you can set off that against any other income during the same year. And if there is any component of the loss which cannot be claimed because your other income was lower, you can carry it forward, but there is no discretion there. You cannot carry forward because you want to carry forward. You have to claim in the year you got it, if there is income.
Yeah.
Then I have a question. What if line of credit is personal, but investment is the holdco? Can you still write off the interest in the same line of credit? I believe Alex already said, and I've said before, yes, we can claim the interest paid on the line of credit on the personal side as well. It could be in the corporation as well. Then you would do it in the most tax effective manner. Your accountant will have to tell you what's the best way to do it. The simple answer is yes, you can claim.
Ato, I would say, depending what your portfolio is, I would definitely reach out to Sanjeev, because if you're using personal line of credit and you actually have holding companies, I can tell you Sanjeev is going to give you the answers that you want to hear in a positive way. So I'd say you should seek out a consultation with him. I think that's a good idea for you.
In your investment property, if you spend $50,000 to build basement, is this tax deductible from rental income in the year? or carry forward? If not deductible in 1 year, how would that impact capital gains at the time of sale? If it is you built a basement, I would say please capitalize it, because that increases the value of your property. You should capitalize it, and at the max you could claim as a CCA against that. You cannot write off that in
CCA, guys, what that is. Yeah, what
is
CCA,
depreciation.
guys, for those that don't know that, it's, I'm just drawing a blank on it. Capital cost allowance. What you're doing is you take that $50,000, and there's prescribed rates specifically for different things. But just for an example wise, you would then write that $50,000 off over 10 years, let's say, for example wise. And that's what you do. So instead of doing it 50 in one, you do $5K a year, for example. There's a prescribed rate. I'm just throwing numbers out. It's not correct. You don't write off $5K per year. But that's what you do in that case, which is good. You don't want to write the $50K off in the first year. You're going to have income over the 10 years. So to be able to spread that out is a good thing.
I'll let you answer the next one. Terrain insurance is not a deductible expense.
There we go.
And then I have a question. 150K spent on renovating 2 brand new commercial offices I bought this year under my corporate. Should I declare as a 150K an expense for? No, it has to be capitalized. It looks like likes to be a kind of a leasehold improvement, and you can write it off in the coming years by way of depreciation. I mean CCA. That's the best thing to do.
And again, if you have 2 brand new commercial offices, you spend that 150K renovating wise. Again, Sanjeev loves commercial properties in regards to building structures around those. I think you should definitely schedule a consultation with Sanjeev, because this is where he excels in building those structures wise. We went into more detail on this in the last call. If you go back and listen to our last webinar, you can see some of the different scenarios we were talking about. So again, I would say definitely reach out to Sanjeev, because if you're asking that question, it means he's probably going to do a lot more for you as well.
Then we have a question. I have many properties under my personal name. I have been depreciating the rental income every year against the property to avoid paying personal income tax. My plan is to keep these properties until I retire, then pay a lower personal tax if I sell them. No, it is a very, very bad strategy. You sell them in a year, you'll pay so much in taxes as compared to what you're paying now. Right now, you'll pay little. Others, you'll pay a very high amount of tax.
Yeah,
it's better not to pay CCA.
Yeah, and I see the line. I don't like the word avoid paying income tax. I don't think Sanjeev likes that word, avoid paying income tax. Nothing we are doing here is about avoiding it. It's deferring it and paying it at the right time and taking advantage of different personal tax rates and everything like that. So you'll never hear Sanjeev use that word. I don't use that word. It's paying the tax at the right time wise. So as he said, that he doesn't recommend that strategy above.
And the reason that there's going to be such a difference is, say you bought a property for $500,000 now, in 30 years, it might be worth 1 or 2 million. That means you're going to have that difference as either a capital gain or income, depending on the situation, which is going to be a massive tax implication. So you're saving a tiny bit now, but in 30 years, you're going to have a huge tax liability that you'll have to deal with.
For this gentleman, I would highly recommend to go for a holding company.
Yeah, so we won't get into too much detail about that, but so the question, and we spent a lot of time talking about it last call, so you guys can go back and listen to the last webinar. If you own things in your personal name, you can transfer them you can still transfer them over to a holding company wise, and there's a whole process, whether it's a paper transfer or legal transfer wise. We're not going to get into all that right now for time constraints wise. But that is possible to do. Okay, so let's go to the next question.
Do you pay a higher interest rate if you hold property in your holdco instead of? No, the rate of interest remains the same. Whether it's a holdco or whether it's an opco, doesn't change.
Yep.
This is based on my experience. I'm not a banker, please.
Yeah, and there may be a slight difference in regards to the interest rate wise. But you're not, because I do know where the question is. There's not a significant difference. You know, it could be in one case you're paying 2.45 on the personal side, and on the corp side you're paying 2.6. Sanjeev might go back to me, no, but I get 2.45. But you're not paying 5 or 6 or 7%. That's not the case. And again, it's all about how you structure it and who you're talking to as well. And you may be being fed information that it's hard to get mortgages if you have a holding company. That's not the case. You're just talking to the wrong person.
I'll add one line here.
Mm-hmm.
When you buy a property in a holding company, sometimes it doesn't even show up on your credit.
Mm-hmm.
And I'm not going to say what advantage you get. I'm keeping mum.
Yes.
Because if one bank doesn't see it,
reach out to us personally.
it's a smart thing. I'm not going to say anything on that.
Yeah.
It happens every day. Can you talk about HST rebate on income properties when the property is rented out? Are there timelines involved? Any HST paid on purchase of any investment property, you can claim it back from CRA within a period of 2 years. That usually they process the claim within 4 weeks to 6 weeks.
I will put an asterisk beside that right now, except right now it is delayed. So that is delayed right now. If you were to file it right now, you may not get it in 4 weeks, just because that department has actually been one that's been closed down during this COVID. So I got to put a little asterisk there on that. But in any other circumstance, yeah, you're typically getting it about 4 weeks wise. And Sanjeev, you offer that service, correct? HST rebate?
We do that. We do that a lot.
And please don't do it yourself. Don't do the HST rebate. Please don't.
I brought a pre-construction condo under my name years ago. I have get a market value and pay HST and capital gains if I want my son to be the registered owner?
No.
This is a very, very dicey question. Any transfer of asset to any person who is not at arm's length has to be done at the fair market value. Otherwise, there's a likelihood you could be taxed on the transfer. Please do talk to your accountant before you do this. What are the expenses should be included in the purchase cost to be considered when I sell my property in future? Any cost you incurred for the purchase of the property will be added to the cost of the property. Pick up your statement which the lawyer has given you, add everything. That's so simple.
Yeah.
I am borrowing money from the home line of credit, but makes a mortgage from my home to buy a property. Does it have? I'm confused at this question. Alex, can you understand that question?
I am borrowing money from my home line of credit, but make it as mortgage from my home to buy property. Okay, so assuming what this is, okay, there's two things. Obviously, there's two different ways to get money from your house. You could have a mortgage or you can have a home equity line of credit. For investment purposes, you want to use a home equity line of credit to then invest that into another property-wise that's going to be generating you some income. So you want to use a home equity line of credit on your personal property. You don't want to refinance your personal property and then go buy an investment property. You're not going to be able to write off the interest. You want a home equity line of credit that you're using specifically only for investment properties. That's the cleanest way to do it.
Alex, there are some questions I see which are very, very personal,
Yep.
which require a lot of math. I think we should give it a pass.
Yeah. If you're going to very, very specific cases, we're not going to be addressing those because it just doesn't make sense.
I'll give the question pass. I'll give the next question of 1135 a pass. Now I come to my husband and I work with corporate with high income, and we have 3 investment properties. Should be on the face of it question. What the gentleman is writing? What lady is writing? I believe yes. But then you need some consultation there.
Yeah, and especially if you're looking to grow the portfolio as well. So you're at that threshold where you're about to make the next jump. So I would definitely give Sanjeev a call about that to see what makes sense to structure was. Oh, you know, this is a great question.
Okay, when one refinances the property for a higher amount from its original purchase through asset appreciation, is that loan amount considered capital gain? The answer is no. Any loan is not a taxable income.
There you go.
Okay, I'll be slow. Would you work full time and hold 3 or more real estates? How do you treat this? Should you consider opening a holdco? The answer is yes, but depends upon your income situation. Do you recommend taking an RSP for a down payment? Is there a rule you take at once? It's basically a long answer. I give it a pass. Are there consequences if you claim a rental loss on your personal income tax return for several years? Well, this I should answer. When you're claiming a rental loss for year after year after year, CRA does come back to you to audit or maybe review your file. I've seen that many times. Make sure you do not claim a loss by putting in some expenses which are not even there. Be honest. That's all I'm going to say here. If I rent out my basement, this is a subjective thing. Generally, CRA has not come hard on this, on renting out the basement. They still treat the property as a principal residence. If I were CRA, I would say otherwise. I want to build a basement. It is better to use cash or take equity from the house. This is to avoid taxes from rental income. Let us not say the word avoid taxes. I would use the word plan taxes.
Mm-hmm.
Yes, if you take out the home equity, you'll be able to write off interest. Simple.
Yeah. Oh, what type of insurance?
Tarion insurance.
That's the Tarion warranty.
Yeah. No.
So basically, I'll answer that. Yes, you can write off the insurance on against your rental income on your property wise. It was just a mischaracterization. Tarion is an insurance. Tarion is a warranty with a new home build. It's only a one-time payment. That's not a write-off against your rental income wise. Insurance you can write off.
Okay. The other is, how can I be more tax efficient about renovating my principal home? It's purely subjective. I'll give it a pass. You'll have to go to your accountant. If I have 5 condos, does it make sense to have a holdco for the properties and a subsidiary opco that rents out the property to limit the liability? It's a very specific question. I think the gentleman knows what he's doing. Yes, it is a kind of a good strategy. If you have an equity in your corporation, does it make sense to withdraw that money to your personal name? I understand tax is equal to 0. If you can prove that you deposit the money in the corporation the previous years, it's a total tax planning. You have to go to your accountant. It's a very, very specific question. The answer to is yes and no both. It depends upon the other factor as well. I plan to liquidate 3 rental properties and gain 1.4 million. You should see your accountant. There could be a huge tax saving here. When I say tax saving, by deferring taxes.
Mm-hmm.
If I miss writing off expenses in a year, I purchase my condo, do I have to claim those expenses in a later year? If you missed claiming any expenses, you can go back and revise your tax return. You can always do that anytime within the next couple of years. I am borrowing money from my HELOC, and then the bank manager advises me to transfer the HELOC to a mortgage against my home so that I can get a lower and a stable mortgage payment. No, it will hit you hard.
And I'll jump in. The person at the bank is not always right. So that's where it's very important to have the right team of people around you. If you're going to the bank wise, you're really dealing with a jack of all trades. Everyone on this call is focused and specialized in investment real estate wise. So very important to make sure you're always talking to the right people.
What is the annual cost to maintain a holding company? It definitely depends on the number of properties within the holding company. But I'll answer this because the cost is usually anywhere between $1,500 to an upwards per year minimum. I am thinking of adding my son to my rental ownership that tax maximized on my death. Upon my death, I'll incur capital gains, but my son's portion will be his primary residence. Can I do that? Please go to your accountant. When you apply for HST rebate to CRA, how much of the amount do I get back? 100%. This is on a new property that will be deemed to be an investment property. Generally, it is 100%, but generally the rebate is 100%. But then there is a formula within the forms. So it could be a bit lower sometimes, but usually it is the same. I've never seen it lower. Can I rent out my condo to my sister at a loss and claim their interest and expenses? I will not answer. It is go to your accountant. Hi all, do you transfer an existing investment condo from personal ownership to a holding company without having to pay 2% land transfer tax? Also, what happens to the current mortgage? I touched this last time. We could roll in the condo to the corporation without paying a land transfer tax. You'll have to consult your lawyer for this. But if you do just a paper transfer, then you don't have to pay a land transfer tax and the mortgage remains as it is.
And then this will be the last question. When should you be refinancing your mortgage, take out a home equity line of credit to use that money to purchase another property? Today. And then what's the benefit of a legal?
I would say that I got a question. What's the benefit of legal transfer versus paper transfer? I would appreciate if the person writes me an email. I'll write him back. I'll respond.
Yeah. Send an email to Sanjeev about the legal and paper transfer. It is honestly, it's a very, very long conversation. And you know what? I'm going to send you an email on that, Sanjeev, because I think I need to write something about that for people. So they get just a general understanding of what it is, because people don't know. Okay, we got 2 minutes left, guys. What's Sanjeev's email? You will be sent Sanjeev's email. What types of expenses are developmental and education fee paid on the purchase of a new build? Not really applicable in this conversation. This is interesting here. What is the best way to gift my kids a rental property and minimize tax?
It's a huge question. It's a loaded one. But having said that, we have to consider his current situation, because any gift is not taxable. But that will be considered as a deemed disposition. Let us say you bought for $200,000, but the value to it is $400,000. You will be dinged on a capital gain on the $200,000. There's no escape route there.
Yeah. And really, it comes down again to planning wise and how you structured and everything like that. So it's definitely a loaded question, and there's going to be a lot of different things you have to do. Well, we're coming up on noon. So Sanjeev, thank you so much for taking this time. Yes, there'll be a recording that'll be sent out to everyone that signed up. So you'll get a of this in a recap email wise. I will be sending out next week an email that kind of just common things that you can write off against your investment property. And I will more go into detail about paper and legal transfer wise. We'll share that information with you all. Thank you for spending time with us. Really appreciate it. Kyle, thank you for moderating wise. So we all want you to minimize your tax, maximize your wealth. If you're interested in booking a consultation with us to learn how you can do more of this, reach out to us. We'd be happy to take you on that journey. Okay. Thanks so much, guys. Thank
you, Alex. Thank you, Kyle.
Everyone.
Enjoy your day. Bye. Take care.